You're watching Keel up 21%. That's the problem. How much has that cost you? Not the trade you didn't take. The next 10 you will, because right now your brain is rewiring itself to believe that missing moves is more dangerous than making mistakes. The Stoics understood something about desire that modern neuroscience is only now confirming. The pain of missing out doesn't live in your losses. It lives in your imagination. And by the end of this, you'll know exactly why the investor who feels nothing when Keel explodes 21% in a day will always outperform the one refreshing their feed. Friday, June 19th, 2026. Markets are calm. S&P up just over 1%. Nasdaq pushing 2. VIX sitting at 16.78. But you're not looking at those numbers. You're looking at Keel up 21%. Hive up 14. Bitcoin hanging around 63,000. And somewhere in your chest, there's that familiar tightness. That voice asking why you're always watching the parade from the sidewalk while everyone else is riding the float. Let me tell you what's actually happening. You're not afraid of volatility. You're afraid of being wrong in a way other people can see. Of sitting at a dinner party while someone talks about the crypto play that doubled in 3 weeks. Of opening your brokerage app and seeing the same boring index funds doing exactly what they're supposed to do, slowly, invisibly, without a story worth telling. The Stoics had a word for this. Fantasia. The impression that strikes you before reason can intervene. The image of wealth gained without you. The story you tell yourself about who you'd be if only you'd bought yesterday. Here's what that voice won't tell you. KEEL's 21% move today. It's noise until you zoom out. Most investors who chase that move will give back those gains and more within the quarter, not because the company failed. Because their entry was emotional, and their exit will be too. They'll sell at the first sign of doubt, or hold through the collapse because they need to believe the story wasn't wrong. This is how FOMO kills returns. Not in the trade you miss. In the 20 trades you make trying to avoid that feeling again. Marcus Aurelius, Roman emperor, investor in grain markets, and military logistics, wrote this in his private journals. The impediment to action advances action. What stands in the way becomes the way. He wasn't writing about overcoming obstacles. He was writing about the nature of desire itself, the thing you think you need to acquire, the move you think you need to make. That wanting is the obstacle, not the market, not the opportunity you missed, the wanting itself. Picture Marcus Wellington, silver hair, 63 years old, hands folded on an old mahogany desk. No screens, no price alerts. A single leather journal open to today's date. Across from him, Alex Chen, 31. Phone face down on the table but fingers twitching toward it every 40 seconds. Alex finally speaks. Keel's up 21%. I had it on my watch list 2 weeks ago. I needed more time to research. Marcus doesn't look up. And if you'd bought it, Alex blinks. I'd be up 21%. Marcus closes the journal. No, you'd be planning your exit or imagining it at 40%. The trade you're mourning never existed. You're grieving a fantasy. The silence in that room is the same silence you need to find. Not the silence of hesitation. The silence of non-reaction. The space between stimulus and response where wealth is actually built. Let me show you what the Stoic investor sees that you don't yet. They see Keel up 21% and feel nothing because they decided months ago what belongs in their portfolio and what doesn't, not based on price action. Based on thesis. They allocated capital according to principles they wrote down when their judgment was clear. When no stock was exploding. When FOMO had no raw material to work with. And here's the part that sounds boring until you calculate the returns. That system, that pre-commitment to rational allocation, outperforms the chase over every meaningful time frame. The research is unambiguous. A Dalbar study tracking investor behavior over 2 decades found that the average equity investor underperformed the S&P 500 by nearly 4% annually. Not because they picked bad stocks, because they bought and sold at the wrong times, driven by exactly what you're feeling right now. The fear of missing the next move, the regret of missing the last one. FOMO doesn't just cost you the trade you didn't take. It costs you the discipline that would have compounded for 20 years. Marcus Aurelius again. You have power over your mind, not outside events. Realize this, and you will find strength. Outside events today. Kiel up 21%. Your mind. Convinced this means something about you, about your competence, about your future. The Stoic investor inverts this. They ask not, what did I miss? But what system failed that allowed me to be vulnerable to this feeling? Because if seeing a stock explode disrupts your strategy, you never had a strategy. You had a collection of intentions, waiting for fear to rearrange them. Here's the framework. 3 questions the Stoic investor asks before every position, written in advance, reviewed when markets are closed. 1. Does this fit my existing thesis? Or am I reverse engineering a thesis to fit my desire? 2. Am I sizing this position based on conviction? Or based on the pain of watching it move without me? 3. Can I hold this through a 50% drawdown without checking the price? Or am I renting it until my fear changes direction? If you can't answer all 3 in writing before you buy, you're not investing. You're itching. And the market charges a toll for scratching. Alex looks at Marcus. So I just ignore Kiel? Pretend it didn't happen? Marcus shakes his head. No, you study it. You ask why it moved. You update your model of the world. But you do it in your journal, not your brokerage account. Information and action are different things. The undisciplined investor treats every new piece of information as a referendum on their portfolio. The Stoic investor treats information as data that might, after careful consideration, adjust a thesis they'll execute next quarter. The VIX is at 16.78. You know what that means? Broad market calm. No fear. No panic. Just 2 stocks exploding and your nervous system convinced that calm is complacency. This is the exact environment where FOMO does its worst work. When the market isn't giving you drama, your brain will create it by focusing on the outliers. Kiel and Hive become the story. The S&P up 1%. The thing that actually matches your index allocation becomes invisible. You're not responding to the market. You're responding to the narrative your fear selects from the market. Here's what Marcus Wellington does on a day like today. Nothing. He reviews his positions. He checks that his allocations match his written plan. He reads for an hour. And if Kiel was already in his portfolio, properly sized, he feels exactly the same as if it were down 21%, because he decided what it was worth to him before the price moved. The price is just information about what other people think today. His thesis is information about what he thinks over 5 years. One of these is stable. One of these is noise pretending to be signal. You want to know the real cost of FOMO? It's not the trade you missed. It's the investor you don't become, the one who builds systems instead of chasing setups, the one who can sit through explosive moves in both directions because their conviction was formed in silence, not in reaction to a price alert. That investor compounds. You're currently oscillating. An oscillation over decades is just expensive noise. Marcus Aurelius died in 180 AD. His portfolio strategy, the one encoded in his meditations, is still working. Yours, the one formed by checking your phone at breakfast, will be obsolete by dinner. Not because the market changed, because your emotions will. Your emotions are costing you more than any market crash ever will. Next video proves it.